I'm going to be real brief today. I more want to go over some of the things that we're working on for Project One, and sometimes I've skipped over a few things that I should be talking about. It's kind of a teaching moment. I asked Erica if I could use hers kind of as an example here, and she gave me permission, so I'm going to throw it up. And I'm not really, in this case, I'm not looking at the numbers so much as just some of these things. First, let's talk about depreciation. Why do we depreciate items? Anybody have any idea? Because they lose value, yeah, that's exactly right. And the IRS, or the government in its wisdom, has said that we're going to do that over time. Now that said, here's a teachable moment right now. The tax law that just changed here a year or two ago has allowed for certain items and for certain companies full expensing, meaning that I wanted you to know that a lot of these items that might be down here, equipment, furniture, fixtures, and vehicles, may now be fully expensed. And those of you that have farm and ranch, relatives, you might ask them. That's a huge deal. I know they did that one year when I was in banking. It's just kind of a quirky thing. They wanted to do it one year because they were afraid we were going into a recession and whatnot. And we called it the suburban law, because every farmer and rancher that we knew went out that year and bought a new Suburban because they could fully write it off, right? They had a pretty good year. They could fully write off the cost of this Suburban in that year. And so tax-wise, it made some sense. It wasn't always the best idea for their operations and whatnot, but tax-wise, farmers and ranchers are just horrible about wanting to pay taxes. I kind of get that, but anyhow. So that's something that's important. Why don't we depreciate land? Land doesn't really change, right? And land values don't really change, okay? They do. I mean, they go up and down, right? But that's like gold. I mean, we can't depreciate. If we buy gold, we can't depreciate it because we assume that the value is going to kind of stay there. It may go up or down depending on speculation and all kinds of other things, okay? And if it goes down and we sell it, we're going to get to take that as a write-off then, the difference between our cost basis and the sales price, right? Okay? The cost basis thing is something that's kind of important to remember. As we depreciate things, it changes our cost basis in it. That's kind of important when we come to things like buildings. A lot of buildings don't really lose their value that much, right? You know, my house, I don't know, my wife and I have been there for 10 or 11 years, and it's worth more today than it was 10, 11 years ago when we bought it, I think, judging by what the neighbors are selling their houses for, okay? Now houses don't matter because you don't have to pay taxes when you sell your own personal residence on. If it was a rental, it would matter, right? Okay. If we had depreciated it for 10 or 11 years, our cost basis would go from whatever we paid for it. Let's say it was, I don't even remember, 150 or something like that. So let's say, we depreciated it for 10 years. Our cost basis in that might only be, $100,000. And if we sold it for $200,000, we'd have to pay taxes on $100,000 of capital gains. Okay. Another teachable thing, capital gains are taxed at different rates than regular income, so that gets even more confusing. You guys, this should inspire you all to want to become accountants, getting into all this really confusing stuff that has to do with taxes and whatnot. But it's really important on the finance. Guess what financial managers do? They're studying that stuff to no end, right, to try to figure out what's the best things to do with the company's money. Should we buy? Should we lease? Should we repair the equipment that we have? Those types of things become huge, especially when you're talking about multi-million-dollar pieces of equipment, right? Okay, so they're really huge. Do we depreciate it? If we can expense it, should we? What if you were starting a brand new business and you had the right to expense something? Well, guess what? The first couple of years, you're not going to make any money anyhow. Why would you even want to fully expense it? Maybe you want to depreciate it so that by year 3 or 4, when you're making some money, the depreciation offsets that income, right? All kinds of decisions that financial managers have to make. So that's kind of all I wanted to look at there. The payroll, hope everybody kind of did this. Remember, make sure you got blanks up here, okay? Even putting any number in there, like if you add, watch down here where it says 20 on this state unemployment, and I've changed this to a 1. It changes that number, even though I've got no pay or anything there. So
cool. So don't even have one owner.
Don't even have anything on there, okay? Because it changes numbers. Even why it's got to be some quirk in the program, and I haven't looked at that deeply into that one, okay? So that's kind of a quirky thing, so be a little bit careful about that. She's got a little workers' comp in here. I forget, what was your business?
Mobile event.
Yeah. So probably not a real dangerous business. So 2.5, probably in the range. You know, that's
When I Googled it, that's what it
yeah,
gave me, so-
good. And you know, from state to state, usually if you Google something like that, it's hard to say because every state has their own workers' comp rules and whatnot, and their own rates and whatnot. But that's probably in the ballpark, and that's fine. And like I said, in entrepreneurship, if you were doing a regular plan, I'd probably expect you to do a little more research and come up with a number on that. Okay. Payroll year 2, and this is good because one of these down here was 10%. It should have been because everything up here is 20%, and you must have changed that or. Okay, so that they match up. That's the only thing. Kind of watch. Kind of take a look, and it wouldn't have to be 20 and 30%. If you wanted to change these, that's fine. I mean, that's some pretty hefty pay raises. I wouldn't give my employees that kind of a pay raise probably unless they were really, really good, right? But I'm kind of a cruel bugger, so I don't know. So if you wanted to change these, that's fine. Just make sure you change them consistently down here. Okay. Sales forecast we haven't done yet, and I guess would be kind of important. Additional inputs, we're going to work on it a bit. But the operating income, let me shrink this up a little bit so we can kind of see it more. You know, did a nice job of going through, making some good estimates of what it was going to be month to month, and we kind of look at some things. Down here you'll see, and this is why I say so many of these forms interact, right? So all of this stuff down here in the white is stuff that came over from our starting point, maybe, right? Maybe some of it from our payroll. I don't think so. Nope. So it came over from our starting point, and it's expenses. Okay. Also, it comes from you had a starting point. There's some debts in there, so you'll see some interest on here and some different things like that. Okay. So that's why it's so important then to remember that all these things go kind of hand in hand. You know, it's a real combination. So we got to look at everything in its whole when we look at this. We go to the operating expenses, and I didn't talk about this one too much at all, but years 2 and 3, again, they've kind of got 3 and 5% estimates here. Probably not bad. You know, they do that on purpose. That's probably pretty legitimate. You could change some of these if you wanted to, and I'll give you an example. Might be rent or lease of vehicles, machinery, and equipment. America doesn't have any, but a lot of times you sign a contract, right, for 5 years, and it's going to stay the same. So if you change that to 0, that may be perfectly appropriate, right? Same thing with rental lease of business property. You might sign a 3 or 5 year lease that it's going to be a fixed lease. Okay, it's not going to go up. And if that's the case, you could put 0 in there. That'd be fine. If you keep the increase in there, that's fine too. Keeping the increase in there's a little more conservative way to look at it, and there's nothing wrong with that. Again, we come down here and we see, you know, depreciation's calculated down here, and it does that for you. It's nice that it does that for you. I used to have some old forms, and we had to do that ourselves a little bit, which wasn't a bad exercise necessarily, but here it kind of does it for you. And then you see interest, right? Commercial loan interest. It decreases all the time, right? Every year as you pay down the principal, okay, you're paying a little less interest each month and a little bit more principal each month. There's a good and a bad to that, right? Interest is deductible. The amount that you're paying down on the principal isn't deductible. You know, and I believe me, I had some farmers sometimes that ended up in some horrible cash flow things as they were getting their land paid off. They might be in the last 3, 4, 5 years of paying off their land. Their payment was still the same, you know, 150 grand a year, right? But almost all of that was going to principal, which they don't get to write off. They'd only have a little bit of interest that they get to write off. And so that if it was $150,000 payment, maybe $135,000 was principal. That's all profit. They got to pay taxes on that technically, right? Unless they got a bunch of other write-offs, and that created some real cash flow issues sometimes. There was those were good problems when somebody was getting that close to paying off their land. That was a good problem that you could work around, but it was a problem nonetheless. You know, it was just kind of one of those quirky things. Vehicle loans, you see the interest going down. We got this line of credit interest. Ooh, ouch, what's that? Well, don't worry about that yet. When you get to the cash flow, we'll see. Okay, poor Erica's got a negative cash flow of $58,000 by the end of year 1. Well, why is that? We haven't estimated any sales yet. Okay, so that'd be pretty normal when you haven't estimated any sales. That's a good number though, right, to shoot for. Okay, here's a cash flow number. I know it's negative. So when I start calculating my sales, because we're kind of doing that, we're going to do that by the seat of our pants in this class. Okay, you better make sure that your sales forecast minus your cost of goods is going to exceed that, right? On the cash flow, at least it should be close. There are cases where you might show a little negative cash flow. There are cases where you're seasonal, where you might show big negative cash flow during times of the year. You know, farmers and ranchers do that all the time, right? Summer months are horrible. They're spending all kinds of money. They got negative cash flow. Fall comes along, they sell all their stuff, and all of a sudden it turns positive. So if you have a seasonal business, you know, lawn mowing or something, that could happen very well. And that's fine. Okay, but the end number may be something when you're looking at it now without any sales forecast. That gives you a little something to shoot for in terms of your sales forecast, right? Okay, I better show a net maybe sales forecast in the $60,000 range or 70 or 80, whatever, right? I get some of these turned in, and the sales for we got expenses here 58. By the way, this doesn't include my payroll, so I could add my payroll to this, and I'm probably going to be closer to 70 in that neighborhood, right? Okay, so you might want to add those two together. So I get these turned in, and they got that kind of a negative cash flow here. Their sales projections come in at about 30 grand, and they're showing a negative 40 grand, right? Well, that doesn't work. Okay, so then I send it back to you. So take just kind of take a look as you finish this, and keep that number in the back of your mind. Add in your payroll, because you'll kind of need to cover. You will need to cover both of those to some extent. Again, it's not unusual either for a company to lose money in the first year, even on a cash flow basis. But then if we're showing some positive gains after that, if your sales projections, for example, for years 2 and 3 are more positive, you'll make that up, and that's fine. Okay. I had about 3 or 4 of these turned in. I've gotten looked at them. I've looked at a lot of the starting points. Going back to that, one thing it's a little bit my fault I didn't mention, and some of you probably did. You probably took another worksheet and you did some calculations on these things, and you imported this number, and you ended up with a fractional number in here, like 1704 and 62 cents. Okay. Well, the 62 cents doesn't show up, and so then you end up down here, and okay, in fact, that's the case right here with Erica, so we'll fix that in just a second or two, right? Okay, it's those 138,741, 138,741. Okay, but we don't have that nice green thing that says you're balanced. Okay, so what's wrong? I bet you if I come up here and I just start going to up. Okay. Yeah. Yeah. So if we just change that to a whole number, 1704 in this case, instead of if you guys see up here what I'm referring to, 170396, screws it up. We're 4 cents off, right? So it kind of shows that we're balanced, but we're not getting the green thing. The negative on that, okay, we could say it doesn't really matter, and it doesn't, but when we get to the final balance sheets, when we're looking at balance sheets 2 and 3 years down the line, we're not going to get those to say they're balanced either unless we fix this here. So we want to make sure that this down here, let me see if I can fix this right now and get it to work, that it's this green, you are fully funded, balanced. We want to make sure that we read that. Okay, and then we'll be fine probably when we go forward and do the final balance sheets. So, questions about that? Okay, we got homework. I gonna remind you guys, I sent you out. I wouldn't call it a nasty note, but I hope you guys read it. That probably 90% of the corrections I made on Chapter 6 were just related to you guys mistyping some information in there. It wasn't that you weren't doing the problems right. You were. And that was just frustrating as hell for me that I'm going through looking at this saying, I see the wrong answer and I go, oh crud, okay, so I'm going to look and find it, and then I look up and I go, oh crap, they just wrote down the wrong number. Simple as that, just wrote down the wrong number, and like I said, I'm happy that you're doing the problems right. I'm trying to be, I am a little nicer when I see an error like that, but I also think that, when you get into the business world, you don't get to make a lot of errors like that, and so you gotta work at being kind of precise on that, and that's the easiest thing to be precise about. Go back and double check, right? Make sure that you got the right numbers entered into your formula. So that's it. I'll quit for the day other than what happens tomorrow, Aaron?
Game.
What time?
1.
Okay, what time's you wouldn't know that because you're going to be at the football game playing, but what time's the tailgate party start? Okay. Dress warm, bring your raincoat, rain gear, that kind of stuff. all that other good stuff. We don't have anything going on tonight, do we? Are there any games or anything?
Cross country in the morning.
Oh, cross country in the morning. Thank you. I sometimes forget some of the other events, and shame on me. I shouldn't. I think it's at 9 o'clock at Prairie Farms Golf Course. That might be kind of fun to watch if they're in the slop. I hate to be. I know that's kind of sadistic of me, but you could sit inside the nice warm, pro shop out there and watch the students running around in the slop out there. It might be kind of fun. Oh well. And then the car show too. If the weather stays reasonable, there's supposed to be a car show out in front of the Cowan Hall. So if it happens to be nice, I might even bring my old pickup up and show that off a little bit. So not my 72 Ford that you guys see me drive, but my 55 GMC. I just kind of finally got back. So yeah. Huh? Well, I got a 65 GMC too, yeah. But it's not restored. It's actually sitting out at my cabin just rotten. My wife won't let me restore it, but I got to go behind her back and get that one done. So, any questions? Okay, you got a lot of stuff due today, so get at her.